Gold has crossed $4,000 an ounce. That's not just a number. That's history breaking through the vault. For centuries, gold has been the world's ultimate symbol of safety. So when it explodes like this, something deep is happening. Is it too high? Or is it still too low? Welcome to FluxFolio Finance. Today, we're diving into the biggest question of 2025. Why gold is soaring, what it means for global power, and how you should think about investing when an ancient metal starts behaving like a modern signal. Why is gold price so high? It's not just hype. The price of gold is screaming something about the world. As of October 2025, gold hovers around $3,980, $4,000 per ounce, up more than 50% from last year. That's faster than stocks, faster than real estate, faster than nearly everything, even Bitcoin for most of the year. So what's behind this unstoppable climb? A perfect storm. Inflation hasn't fully gone away, even if the headlines say it's cooling. Yet real interest rates, the difference between inflation and what bonds pay, are still close to zero or negative. When your savings earn nothing, holding gold doesn't feel like a waste. Some central banks, especially in China, Poland, Kazakhstan, and Singapore, are buying gold like never before. In 2024 alone, they added over 1,000 tons to their vaults. And here's the big one: geopolitical fear. Trade wars, military buildups, elections, debt crises. When the world gets messy, gold becomes the universal passport of trust. So yes, gold is high, but it's high for reasons that tell us the system itself is under pressure. Is gold too expensive or still too cheap? Here's where it gets interesting. Every time gold hits a record, people say it's too expensive. But is it? Let's compare. In 1980, gold hit $850 an ounce. Sounds small, right? But adjusted for inflation, that's almost $3,000 today. Now, with global money supply more than 10 times larger than in 1980 and debt at historic highs, maybe $4,000 gold isn't expensive at all. Some analysts even argue that fair value gold, if it were fully backing all US dollars in circulation, would be closer to $10,000, $12,000 per ounce. That's where the wild theory enters. What if the US Federal Reserve revalued its gold holdings at Fort Knox to back the dollar, or even used gold as a tool for monetary policy? Imagine, the Fed sells gold to absorb dollars, like gold-based quantitative tightening. Then, when the dollar strengthens and gold falls, it prints new money to buy gold back, a reverse QE cycle. Sounds crazy? Maybe. But in a world where deficits are endless and faith in paper is fading, nothing is off the table. What does a high gold price mean for the world? A high gold price is not just about demand. It's a reflection of distrust. It means investors and even nations are quietly saying, we don't trust central banks to keep money stable forever. That's why China and its allies are hoarding gold. They're building a metallic firewall against the dominance of the US dollar. For them, gold is a geopolitical weapon, a hedge against sanctions, and a store of sovereignty. But here's the twist. As China loads up on gold, America may be choosing something else entirely: Bitcoin. Could Bitcoin replace gold? It sounds absurd, but not impossible. The US is watching China's golden fortress grow, and instead of chasing it gram for gram, Washington might be building a new kind of safe haven: digital, borderless, decentralized. Bitcoin ETFs have already attracted billions in institutional inflows. Big players like BlackRock and Fidelity are turning BTC into a Wall Street product. Why? Because Bitcoin, unlike gold, can move instantly, be audited publicly, and, most importantly, doesn't sit in vaults that foreign powers can seize. Imagine a future monetary chessboard. China's alliance holds gold. The US and its allies hold Bitcoin. Each side trusts its own definition of real money. So when you see Bitcoin rising alongside gold, it's not competition, it's evolution. Two safe havens for two ideologies. So what happens next? Let's play out the scenarios. 1. Gold keeps rising. Central banks keep buying, real interest rates stay low, and fear keeps spreading. $5,000, $6,000 gold becomes possible by 2026. 2. Gold stabilizes. Prices cool after overbought conditions. It trades sideways while Bitcoin captures the spotlight. 3. Gold falls. The Fed turns hawkish again. Real yields climb and the dollar strengthens. That would test $3,000 support, but the long-term floor likely stays high because central banks aren't sellers. Whatever happens, one truth remains. Gold doesn't move fast unless the world is nervous. And right now, the world feels very nervous. What can we do? So what do we do when gold is both high and meaningful? First, don't chase. If you buy at the top out of fear, the market will punish your emotion. Second, think in tranches. Gold is long-term insurance, not a trade. Build positions slowly, especially on dips. Third, diversify your hedges. Some exposure in gold, some in Bitcoin, maybe some in inflation-protected bonds. That's a modern, safe haven trio. Fourth, watch real rates and central bank behavior. Those two forces ultimately decide if gold breathes or burns. And finally, remember why gold exists. Not to make you rich, but to keep you not poor when everything else melts. So, is gold too high or too low? Maybe the real answer is, it's exactly right for the times we live in. A $4,000 gold price isn't just about markets, it's a message about trust. Trust in governments, in money, in the future. Gold shines when faith fades. Bitcoin glows when systems strain. Both remind us that money at its core is belief, and belief is shifting. This is FluxFolio Finance, where we decode the stories behind the numbers. If you found this episode enlightening, share it, comment your view. Is gold a bubble or just getting started? And don't forget to subscribe for more deep dives into the world's financial turning points. Until next time, hold conviction, not panic, because in a world losing faith, clarity is your most precious metal.